Hey folks, Fynex here. In this video, we are going to learn what's a market is out there and how to choose the best market to trade and investments. So before you learn how to trade, you must need to understand where to trade, right? So there's different markets and different instruments, different assets you can trade here. Some market is built for the trader and some market is for the investors. There's different markets, I told you, right? So in this video, we are going to understand the second video, module 1.2, the foundations of the markets, the first 10 theory classes, and it's the second video. In this video, we are going to understand the types of financial markets. See, if I'm taking any examples, for example, if you want to be a trader or the investor, okay, we are taking as a trader, and here we are taking, for an example, if you want to become a sportsman or sportswoman, okay, sports, just take it as a sports, as a trading. And there's like a different markets, right? Different markets out there. We can just consider if you want to become a sports person, there's a different kind of sports out there, right? So some examples is like football, something, right? The next is running. If you want to become an athlete, and next one is racer. The next one is volleyball. So these are the different kind of sports out there. You need to choose which sports person you want to be, and then you need to choose the sports categories, right? For example, if you're choosing the running, okay, if you're choosing this running, in running there's a different kind of instruments in this running. It can be like 100 meters relay, right? The marathon, and something, right? So on, so on, so the same things market, we can see the same things in the markets. So if you choose the markets, there'll be like a different kind of markets. The four markets, the major markets. The first one is stock market, which is equities. We can trade and invest in equities, okay? Equities. The next one is Forex market. Forex market, the second one. And we can do the crypto market. And the next one is commodities. And some other instruments, okay, derivatives, futures, options, something like we can take as a running as a sports, and in that running we can see a different bunch of instruments or bunch of things inside that running sports, right? The same thing when you take the stock market, for an example, if you choose stock market, there will be like a different kind of assets, instruments that you can trade or invest. It's going to be like an equities that comes in stock markets. The next one is futures. The next one is options, okay, and then index. See, in a single market you can see different kind of assets, different kind of instruments that you can trade or invest, okay? We're going to understand that in this video. And before I start this video, you must need to note one thing. If you build a strategy, or if you done a frameworks, and if you build a strategy by using that framework, it won't going to be succeed in every markets. For an example, if you build a strategy for stock markets in separate instruments, for example, if it's working in equity, that doesn't mean that it's going to be working in Forex market. It's going to be working crypto markets. It's going to be working commodities markets. These are the different markets. For example, if you become an athlete, if you become a 100-meter champion, you won't be like a football player, right? The one thing is going to be used here, you're running. That's going to be used in football. But you can't be a football trader, like a pro trader. Sorry, the football player. Okay? Hope you get it what I'm saying. So if you build some strategies, it doesn't work in every markets. Some strategies works. And something works in every markets. That's what? That's a framework. Okay, so we can understand that here in this video. I know you are confused. Okay, we're going to clear each and everything in this video. First, we are going to understand what are the types of market are exist in the world. Okay, the next one is what's the difference between these all the markets, and at the end we are going to decide which market suits for you according to the volatility, spread, liquidity, and your time schedules. Okay, we are going to find the 4 answers in this video. Yeah, the first one is, see, we can categorize in 4 markets, okay? The 4 assets, the 4 instruments in this market. The first one is Forex, okay? It's like we are exchanging currencies. For an example, if I'm planning a vacation, Okay, it's just an example. It won't work like that. Okay, just an example to uh, make it easy for you to understand. Okay, if I'm planning a vacation to Dubai, okay, my hand is very worst. Even I can't read this one. Okay, yeah. If I'm planning to vacation at Dubai, for example, I have in my hand INR, right? I'm from India, so I have INR in my hand. So if I spend some money, if I purchase something, I must have the real. Okay. So what I'm going to do, I'm going to exchange this. Okay. So what you mean by exchanges? The exchange, which means I'm buying something and I'm selling something. Okay, it's an exchange. It works like an exchange. For example, here what I'm doing, I'm going to sell this INR and I'm going to buy this real. Okay, buy this real. This is how the exchanges works, right? So that's the forex. Forex means you are exchanging each country's currencies. The one thing is buying and you're selling. Is okay. So this is called the exchange. This is how the forex works. Forex means foreign exchange. The name itself is saying, right, the foreign exchange. So it won't be like this, but we're going to understand it deeply in this video. Okay, so the first thing is we are exchanging the currencies all over the world. Like it can be like a USD euro, GBP AUD, Japanese yen versus AUD CAD. These are the things. Okay, in forex there is like a three instruments: major, minor, okay, and cross pairs. We're going to understand that later. Okay, the next one is equities. So what is equity? You are going to be a co-partner in a company. Okay, for example, if there is any company that's exist, okay, we can just take it as an example, just an example. There's a company called Fynex. Okay, and if you want to be a partner of this company and you have the small capital, just imagine you have the small capital and you're believing that this company is going to be make it a big impact in coming years, for the next 5 years, 10 years, something like that. And if you have the small capital, for example, if this company value is around, just an example, it's 100 crore, okay, and you have how much? Just a 10,000 rupees. You can invest in this company in equities and you can be a shareholder. Okay, shareholder. It's a beauty of this equity. You're going to be a co-partner in that particular company by just investing a small amounts. You can invest anything. Okay, you can invest small or big. That depends on you. Okay, if you have the big capital, you can do the fundamentals analysis, the technical analysis, and after that you can invest or trade in that particular company. If you're trading the equity, if you're investing in equities, if you're investing in trading in a original stock in a spot price, it's called the equity. Okay, and equities has their body doubles or the copies, that's called the futures and options. We can understand later. Okay, right now just imagine you're trading in a original stock, you're buying some original shares, that's called the equities. Okay, the public traded companies. See, if I have a company and I need some more investments from the peoples, I'm going to some exchanges, I'm going to list my company in exchange and people are going to buy my shares, my company shares. Okay, we can understand that. The next one is crypto. So in cryptocurrency, people are using for the transaction purpose. Okay, that's it. So in back days, it's very hard to do some transaction between two countries. So in this case, I'm going to buy some cryptocurrency from here and I'm going to give this password, or I'm going to transfer to the next wallet. He can be anywhere in this world. Okay, and it's done by within seconds, within minutes. Okay, that's how the cryptocurrency is created. And after that, people are looking this one as an asset. Right now it's an investment platform. The crypto is an investment platform. The next one is commodities, the physical goods that we're getting from earth, which is like three type of commodities there. Okay, we're going to understand that. It's an example like gold, oil, silver, copper, rice, coffees, agricultural things. Okay, this all comes in commodities markets. Oh, we get it. You understand the four markets, right? So right now we are going to understand the deep about these other markets. Okay, the first one is forex market. The forex market is called as a liquidity giant. Why? Because there is some more people are trading, are involved in this forex market. Even every country is involved in this forex market. The daily volume is $7.5 trillion. Just imagine this thing. $7.5 trillion each and every day is a market volume. It's getting transacted each and every day, $7.5 trillion. Imagine how big this market's. Okay, and it's going to be open 24/5 which means it's going to be open 24 hours and 5 days. Sorry, 5 days. It's off only in weekends. Okay, Saturday and Sunday. It's off days in Forex. It's 24/5 access. You can buy, sell, hold, anything. Okay, you can hold in weekends also, but it's a tradable with just 5 days and 24 hours. There's no closing time in 24 hours. Okay, the next one is major. There's like a different pairs, major pairs, minor pairs, and cross pairs. Okay, we're gonna understand that later. See guys, it's just a headline for understand these are the markets. Okay, these are the instruments. I'm going to create a separate videos for each markets, separate video for Forex, separate video for crypto, commodities, and stock markets. So in that video, we're going to understand deep about these are the markets. Okay, after this 70 classes, after this 70 videos, I'm going to create the separate videos for these all the things. Okay, here we are going to just understand some basic things. Okay, our main motive is become a trader. My motive is teach you trading. Okay, and it's just basic things. This is something you need to know before you start trading. Okay, that's it. What is the markets and how market works? Each and every market works. How to choose the best market. That's it. Okay, something deep dive we can learn after this classes. Okay, drives. Okay, how the price moves in like a Forex market. Do you really think that the price is moving by putting like $1,000, $10,000, something like that? Some retail traders are putting their money. That's how the price moves, right? The next class we are going to understand who moves the markets, the participants of this markets who are buying and selling in this market. The next class. Okay, in that class we are going to understand some whales, some retail traders, dumb money, and some smart money in that class. Okay, right now see, it's moving on based on the interest rate, GDP, geopolitical stability. We already know that it's involved the central bank, it's involved the governments. So that's why this price is going to move by interest rate. If a particular country is hiking or they're decreasing their interest rate, it's going to be impacting their currency, in their economic system, right? The country's economic system, and it's going to be impacting their currencies. So that's the event we can see in Forex. The next one is GDP, their growth. The next one is geopolitics. Exactly. Some of the news, some of even our rumors can move the markets, can make people's panic selling, or it's going to be make people's greed, fear of missing opportunity. We're going to understand that later. Okay, in separate classes about these other things. Right now, just write it down. It's moved by interest rate, GDP, geopolitical stabilities. Okay, the next one is equities. Okay, so what is equity? Equities and index. Okay, these are the two things we are going to learn here. So the equities is like original stocks, the real stock. Okay, real shares, real company. We are buying real company's shares and we have become a co-partner. Okay, so for an example, we can take it as an example. Just a second, guys. Yeah, Tata companies. Okay, Tata have their different types of company. Tata Motors, Tata Energies, and there's different sectors they're contributing in the stock market. Anyway, just take it as an example. If Tata Motors, if they want the big funds for their companies, they're going to an exchange to list their company, and they're going to give the IPO, initial public offering, so the public people can invest in that company, and they're going to list in exchange. Okay, exchanges, they're going to list in there. So it's called stock market. Okay, they come to the stock market, they participate in exchange, and they list their company. And if I'm seeing for the next 10 years or the 5 years or anything, okay, for the future, if they're growing very well, for example, if I'm doing some analysis like a technicals analysis, fundamentals analysis, right? In the last video we learned about that, the fundamental analysis that's used for the investors. Okay, the technical analysis, that's a framework for the traders, right? If I'm doing any analysis and I find that, okay, next 5 years or even next week, if Tata Motors is going to make a good movements towards the upside, I'm going to invest from here by using my broker. Okay, what is broker? What is exchange? We are going to learn in next class about the participants, market participants. Okay, so see this, how Tata Motors comes as in equity. We are buying the original stock. Equity means we are buying the real shares. Okay, and equities has their body double. Body double means their expiry futures. Okay, we can understand that later in this video. And that's futures and options. Okay, that's a different case. So in this case, equity means we are buying the original stock, the real stocks, and we're going to hold that for the next years, for the 5 years, for the 10 years. We can create the wealth by investing in such stocks. Okay, if stock is moving, for an example, if it's 100 rupees, the Tata Motors, and if it's moving to 100 for the next 2 years, I'm make returns of 100% returns in this particular movements within a short time, right? Within 1 year, within 2 years. That depends on the stock movements. That depends on that company performance. Okay, we're gonna do some analysis later. Okay, right now we just understand what are the markets. It's called the equity markets. Equity market means you are buying the real stock and you have become a co-partner of that particular stock, of that particular company. Okay, by just investing a small amount of money. That's where the equity comes from. Before we trade in equities or before we invest in equities, we must need to understand something that the market has. Okay, the market has is difference in each and every countries. Okay, in India, the market has is 9:15 to 3:45 p.m. Okay, in this time you can buy and sell in equities. Okay, you can invest, you can buy, you can sell in this time. For example, if you're taking as a intraday trading, we can understand that later. Okay, otherwise it's going to confuse you. Okay, the market time is different in each and every countries. Okay, note it down. And some countries have their lunch break. Okay, in Singapore markets they have their lunch break between open and close. Okay, anyway, and the next one is growth, driven by the stock equities, driven by corporate earnings and sector in innovations. Okay, we're going to understand what is sector, and it's a corporate earnings because we are buying some individual stocks and we are become a partner in that particular stock. Okay, which means that company, if that company is doing very well in their earnings, in their management, each and everything, that shares also going upside, right? It's also making a bullish momentum. Otherwise, if, for an example, if they're making losses, that company is making losses and the management is also doing some poor things, it's going to be fall. The share price is going to be fall and we are going to make some losses in that particular equities. Equity means you are the owner of that particular share. Okay, that's it. The next one is dividend. So what is dividend? Dividend means a potential passive profits sharing, which means if the company is making profits year on year, you will get the earnings and each and everything. Okay, if you invest in equities, or you can do the analysis in such a stocks, that's called the fundamental analysis. Okay, and if that company is earnings profits, you will also get the dividend. You will also get the part from that profit because you are the co-partner in that company, right? If you're buying equities, you have become a co-partner in that particular company, so you will also get the dividend. Dividend means you will get your shares from that profits. Okay, the next one is index. So what is index? For an example, just take it as an example. There's a 5 banks. Okay, 5 banks in a stock market, and they're going to make this as a sector. How? For an example, if there's a 5 banks, we can just name it as a 5 banks. Canara Bank one is, and next one is HDFC, and so on and so on. So for an example, and these 5 banks is combined and they're going to create the sector for these 5 banks. This is called the bank sector. Okay, the bank sector. I know that many people are just confused about these all the things. These are the maths, these are the terms. Okay, don't worry, it's just a beginning class. Okay, you're going to understand each and everything in coming classes. Okay, don't worry, just write it on what you understand. And after this class, just go and search in any AIs, chat GPTs, Gemini. Okay, use any AIs and search your doubts. Okay, clear it after this class. Okay, so this is how the sector is created. Okay, if a stock market, they have the specific companies that's related a single sector, that's providing a single service for the markets, that's going to be create a sector, separate sector for that. Okay, for an example, if there is any company that's providing energies, okay, and some 10 companies, they're providing energy to the markets. Market means they're providing the services. Their earnings comes from the energy, which means they goes to the energy sector. Okay, they goes to energy sector. So that's how the sector is creating. The sector is include the stocks. Okay, and you can do the analysis by looking at the sector analysis and the equities. So you will get the detailed analysis. If you want to buy, if you want to sell, you must need to do the both analysis. If that company is contributing any sector, you need to do the analysis in sector also, the index. Okay, it's called the index. So here in India, we can see a Nifty 50 as an index. Okay, Nifty 50, which means it's a 50 stocks combined. Okay, it's showing the strength of this 50 stocks. and we have bank nifty. Okay, bank nifty means it's showing all bank sectors, all bank stocks that's combined a sector, and this sector is called bank nifty. Okay, what is nifty? That's an exchange index from NSE, National Stock Exchange. Okay, we're going to understand the next class about that. So the next market is crypto markets, the digital frontier. So what's a crypto market? I already told you, right? The crypto is created for the transaction purpose, but when it's getting high valuations, people are looking for an assets for the long-term investments and speculative tradings. Okay, the speculation. So you can do the both in crypto markets. In each and every markets, you can do the both. Okay, either you can trading or take it as an investments. Okay, so in crypto we can see the three asset classes. See guys, I told you, right, I don't have much time to explain these all the things in a single video. Okay, it's a brief explanation needed for each markets. I'm going to take a separate video. I'm going to make a separate video for each markets after this classes. Okay, just subscribe this channel, you'll get the all details in this channel. Okay, anyway, see, the plus point of this crypto market is it's running 24/7. There's no close in this markets. Okay, it's run 24 hours a day, 7 days a week, 365 days. It means if there is any event in this world, there's no weekends close in this markets, nothing. It works anytime. Okay, this is why most of the 9 to 5 peoples who are busy in like a day times, they're busy in like a stock market time, they're going to trade and invest in crypto markets, but it's high volatile. Okay, we're going to understand that later. See, it's driven by 24/7. The next one is it's a smart contract without a middleman. In each markets there's a middleman, the exchange brokers, okay, market makers, this all comes in as a middleman. But in crypto market there's no middleman, there's no exchange. It's a decentralized. Okay, it's a blockchain technology. It's not created by a single person, it's not controlled by a single group or governments or anyone. It's non-controlled. Okay, it's a decentralized, no one is controlling this markets. Okay, it's the movements depends on the supply and demands and some geopolitics. Okay, we're going to understand that later in separate video about this crypto markets. The next market is commodities. Okay, and there's two commodities in this market, two assets. Okay, two instruments in this commodities markets. One is hard, just a second, yeah, one is hard commodities, the next one is soft commodities. The hard commodities, which means we're taking out these commodities by doing mining. Okay, this is like a gold, silver, oil, copper, these are the things we do the minings. Okay, the next one is soft commodities, which is like a wheat, coffee, rice, barleys. Okay, so the agricultural things that's grown by products, that's by farming. Okay, these are the two commodities we can trade in markets. It's also run by 24/5. Okay, 24/5, 24 hours, 5 days a week. Okay, so why I'm giving the timings, you must need to understand what your time schedules and which market is suitable for you according to these all the timings. Okay, the difference is like gold will be, this hard commodity will be high volatile, which means in a short time it's going to make a big movements in a short time. Okay, but the soft commodities, that will be like low volatile, because it's this price is depends on like geopolitics, supply and demands. The thing is, this commodity markets is hold $3 trillion, $3 trillion volume each and every day, which means people are buying and selling worth of $3 trillion each and every day. Okay, the oil, silver, gold, copper, these things, hard commodities, that's traded 3.5 trillion, $3 trillion each and every day. The next markets is going to be like bonds. So what is bonds? Bonds is like you are giving loan to the governments. The government is taking loan from you. Okay, it's like before you invest in a bonds, you must need to understand the interest rate, the yield. Okay, the yield, which means interest rate, how much returns you will get. Okay, it's a fixed invest. Okay, it's a fixed return. It's like a fixed deposit something. Okay, a fixed deposit something, fixed return in something, because you are taking a contracts before you invest in bonds. For example, if it looks like 5 years, for the next 5 years 10%, which means if you invest 10 crore for the 5 years, each and every year you're going to get the 1 crore rupees for the next 5 years as a profit. Okay, which means you're giving loan to the governments, so the government is going to pay you the interest. Okay, and when the yield is rising, for example, it's a yield chart. Okay, you can see you can do the analysis by checking the yield. Okay, the yield, interest rate, these are the things. Okay, that's analysis needed if you investing in the bonds. Okay, If you're checking the yield, for example, if yield is rising, which means that the stock market is going to be collapse, the stock market is going to be fall at the time. Because see, why stock market is going to be fall? Because people are going to sell at these all the places and they're going to invest in this yield. Yield means in the interest rate. For example, if you're getting more interest rate from the bonds, it's a safest place to invest, right? You will get the fixed returns. For example, if you're getting the high interest rate, you're going to you're going to withdraw your money, right? You're going to sell your stocks and you're going to invest in this bonds. Okay, that's a simple maths. That's a simple thing is going behind this. Anyway, it's a risk like historical safer than stocks. It's very safe compared to stocks investments and these all the things. And recession indicators, the inverted yield curve predict the economic downturns, which means I told you, right? It depends on the yield. If there is a high yield, which means people are more involving in this bonds investments. Okay, investors loan money to governments, corporations, exchanging foreign investment coupons. This is how the bonds works. Okay, the next one is derivatives, advanced contracts. It's very complicated. Okay, if you take these are the markets at the one side, in every markets this derivatives works. Okay, derivatives applied in every markets. These are the different kinds of markets, right? The 4 markets, there's a different kind of markets, but in each and every markets we can see the derivatives. Okay, this is why I told you it's a complicated things. If you're a beginner trader, you must need to understand these all the things. It's going to be like complicated. Okay, it's like what I can say, you're trading, you're investing in the body double. For example, what is futures and options? It's like you're getting future contracts. You're not getting a real stocks. You're not going to be a real co-partner in a particular stock. I know it's confused you, but let me explain this. Just look at me. Okay, I'm in front of your screen, right? This is me. This is a real me. Okay, this is a real person. And for an example, if I create a body double of me, which means he going to move same like me, he going to eat each and everything is like me, but the difference is he going to expire every month. For example, it's a March month, right? March month is going to expire. So after the March month, I'm going to create the next separate body double. Okay, the new body double, and is going to expire in April month. So after this April month, I'm going to create the separate body double. Okay, and he's also going to expire in May month. So May month means every month's end, it's going to be expired. Okay, so which means see this, all movements, all are moving, all are eating, each and everything is same like me, but the difference is they're all the body doubles. The body doubles has expires, but I'm the real one. I don't have expires. Not in real life, but I'm saying an example. Okay, so in this case we can take it as an example, like if some stocks, we already told you, right, the Tata stocks. Okay, Tata stocks, this is a real stock. If you buy in equities, you are going to be a co-partner in this particular company. So you are going to be a co-partner in this particular company, and when this company is making earnings, you also get this part of it, the earnings part. That's called the dividend. We already learned that, right? At the same time, if they create the body double, okay, if they create the body double, and each and every month the body double is going to be expired. Expired means if you buy the body double, if you buy this futures, okay, we don't use the body double, we use the words, the real things. Okay, that's works in markets. It's called the futures. Okay, the futures works here. If you buy this future, the March month, okay, March month future, you buy from here. Okay, and at the March month end, it's going to be expired. Expired means if you don't want to exit these positions, it's going to be exit automatically without your concern. Okay, without your permission, it's going to be exit itself, which means it's going to be expired in this month. So instead of buying equities, why people are investing, why people are buying and selling the futures? What's the reason for that? So this way the leverage comes here. Okay, so we're going to understand that leverage in coming classes. It's going to be like a loan you're taking from the brokers. Okay, we're going to understand that later. For example, I'm just giving an example. It won't work like that, just an example. See, if Tata Motors equities worth, its share is running at 100 rupees for an example, and if you want to buy the 100 shares, you need minimum how much you needed? 10,000 rupees. You needed 10,000 rupees to buy 100 shares when it's running at 100 rupees, right? At the same time, if you're buying in futures, you just needed 2000 rupees to buy this same 100 shares. So where you get this 8000? The 8000 is given by the brokers. Okay, brokers, exchanges. So they're giving you the loan to buy and sell the futures. Okay, this is why most of the peoples are trading in futures and options, because they're getting loans. It's called the leverage. Okay, you can select the leverage, how much leverage you need to use in some brokers. Okay, we're going to understand that later. That's a different class. I told you, right? It's a complicated thing, the derivatives. Okay, we're going to understand that later and clearly about the derivatives. I will make a separate video for this. Just try to understand. The derivatives means it's not the original stock. Okay, it's not the real things. You're buying the body double, and that body double has expiry dates. Okay, the futures means it comes in index and equities. Okay, the options that comes in index and what's that? Equities. Okay, at the same time, CFD, the speculative price, that comes in gold, forex, and oil. Okay, let's understand here. I'm just removing these other things. So we're going to understand where this futures and options and CFDs works. Okay, so why the people are investing the futures and options? Because they're getting leverage. Okay, they're getting leverage. That's why they buy and sell the futures and options. You may ask that if it's expiring within months, why we need to buy and sell in futures and options? It means, for example, if I'm doing analysis, and in my analysis, I know that the Tata Motors is going to be make a momentum from 110, 100 to 150 within the next week. Within 2 weeks, I'm going to buy the futures. Okay, instead of equities. Why? Because I'm getting more shares in smaller capital. In my small funds, small capital, I'm getting more shares by using leverage. Okay, that's why I'm going to buy the futures. At the same time, I'm going to sell the futures also. There's an option that I can sell the futures. But the difference is, for example, if I buy from here, okay, the negative of this futures, if I buy from, it comes like this, it's 100 rupees, and I bought from here at 100 rupees, the 100 shares. Okay, it's cost 1 lakh rupees. Sorry, the 10,000 rupees, but instead of 10,000, if I'm buying futures, I just needed 2,000 rupees, right? Because I'm using leverage. Okay, that's why I'm trading in futures. Otherwise, I can invest in equities. See, here I'm getting the leverage. That's why I'm trading in futures. Okay, so for an example, if it's running at 90 rupees at the end of the months, okay, end of the months, it's running at 90 rupees. So I don't like to exit these positions. I want to hold these positions till get the good price, so I can buy from the profits. Okay, sorry, I can sell at the profit. I bought from 100, so I can sell at the profits when it's making a momentum towards the upside. For an example, it's a month end. It's take it as an example. We come to March 30th and it's running at 90 rupees. I don't like to sell this price. I don't like to sell these positions because it's running in losses, the 10 rupee losses. Okay, so what happen if I need to hold these positions? It won't happen, because I bought the futures. Every futures has an expiry each and every month, end of this month. So when it comes to the end of this March month, it's going to exit in losses. It's going to exit in losses without my permission, without my consent, because I bought the futures. If I bought the equities instead of futures, I can hold this. Okay, and I can sell it my own. The market won't go to square off. Okay, this is called the square off. Okay, if market is selling by its own, it's called a square off. Okay, hope you get it what I'm saying. What's square off? When the market is going to sell that positions without your permissions. If you're buying or selling the futures, and if you're holding till the month end, which means it can be in a small profits, or which means it can be run in a small losses. You're going to hold this to recover your profits, to recover your losses. The market is going to sell itself because you bought the futures. When it comes to the expiry dates, it's going to be sell that self. Okay, that's called the square off. Hope you get it what I'm saying. And you can use the futures and options in stocks, which is equities. Okay, stocks means equities, and you can use this index. So what is index? Index means the sector. If you take the 5 banks from a markets, and that's 5 banks create a sector, and that sector is showing how strength is these 5 banks. For example, the 3 banks is making a good momentum towards the upside. The bank indicators, the bank index also making a momentum, a bullish momentum. That's also make the bullish momentum. Okay, that's always copy the strength of this all bank sectors, all bank equities. Okay, so you can do the futures and options in equities and index. At the same time, you can do the CFDs in gold, forex pairs. Okay, Forex pairs, and the next one is oil, commodities. Okay, commodities, Forex, you can use the CFDs, the speculate on price, which means you can buy the large amount of positions with your small capital by using the leverage. So you can just select the leverage like a 10x, 20x, these are the things. 10x means you having just 1,000 rupees, and if you're using the 10x leverage, which means you can buy something that's worth of 10,000 rupees. Okay, but your capital, the actual capital you invested just 1,000 rupees, but you can buy the worth of 10,000 rupees by using this leverage, the 10x leverage. Okay, next one is spot versus future settlements, how the spot markets and the future markets works. This is already we learn about the last slide about the futures, right? On the spot, the transaction happens immediately. You take the ownership of that asset at the current market price today. Okay, which means you're buying an equity and you become a co-partner. You owning that ownership of that particular shares what you bought, and that's showing the current market price. Okay, there is no difference in current market price. It's showing the real prices of that particular stock. Okay, at the same time, future markets forward looking, which means it's an expiry in coming days, right? The forward looking, you trade the expectations of the price at a specific expiry dates. In a future, leverage is common. See, what's the difference between a spot price and a future markets? It's a difference between in prices also. For an example, if I'm doing spot price tradings in Tata company, if it's running at 100 rupees, we can take it as a futures. What are the futures? Futures is going to be expired. The people are using the futures only for using the leverage. So in small capital, they can buy the huge quantities. Okay, that's why the futures trading, many people are just attracting for the futures trading. Okay, for an example, if you're buying Tatas for the March month future, okay, March month future, it's maybe running at 101 rupees, but when you come to the April month futures, it's running at 103 rupees, and May month futures is running at 105 rupees. You must need to give the high value. The market, the spot price is different than the futures. Futures is always higher than the spot price. Okay, because you're using a privilege, the leverage. Okay, leverage is a privilege only for the expert trader, the pro trader, who know the markets, who know the risk management, who follow the risk management, each and everything, the rules, each and everything. Future price is always different than the spot price. And here we are not looking at market timings, because market timing is the same like stock markets, because it works in stock market. The futures and options that works in stock market. The CFDs that works in Forex and commodities. Okay, the futures, crypto market has also futures. You can buy the futures options. Okay, in crypto markets. Yeah, anyway, the next one is exchange architecture. There's a two exchange. One is centralized, one is decentralized. So what is centralized and decentralized? For example, if you're buying any stocks, any assets that's listed or that's controlled by a company, or it can be group. Okay, it's called the centralized, which means someone is controlling these assets. Okay, even stock market stocks is controlled by exchanges. Okay, there's two exchanges in India, NSE and BSE, National Stock Exchange and Bombay Stock Exchange. Okay, these are the two exchange controlling all the equities, all stocks, all companies that's related to Indian markets. Okay, the indicators, the index and stocks, futures, options, these all the things is controlled by the exchanges. Okay, that's a centralized. The next decentralized exchange means it's not controlled by anyone. It's mostly comes like a wallet. Okay, it's like a creating wallet and you're holding your assets there. Centralized means you're giving your capital, your money to a certain companies, to the exchange, and they're going to control you, they're going to keep your capital. Okay, the negative is like if you want to withdraw and some exchange is going to freeze your withdrawals, which means you need to wait till this process done. Okay, in this scenario you don't need any permission. No one is controlling your capital, no one is controlling your money. Okay, it's not related to markets, but at the same time it's related about your capital, your exchanges, your investments. Okay, hope you get it. Don't get confused, right? You're not in confused, right? If you have any doubts, don't worry, just comment in this video. Otherwise, just message to the support team, they're going to clear you. Okay, whenever you just getting some like a doubts, just write it on the notes. Okay, and message to the support team, they're going to clear about this. Okay, See, the decentralized exchange, the decentralized wallet, which means you are controlling your own wallets. There is no second party, there's no middleman in this. Okay, here we can see some like a companies or exchanges, they're going to control, or they're going to keep your money. It's like you're investing, you're keeping your money in this exchange, and after that, if you want to buy some assets, you can buy this asset, you can sell this, and this money is goes to the exchange, and after that you can just withdraw here to your banks, then you can use that money. Okay, from here you can't use as like a bank balance, as like a bank accounts. Here is like a company is holding your money, but you can invest and buy and sell from here, from this account. It's called the demat accounts, it's called the wallets. Okay, the Binance wallet, NYSE, New York Stock Exchange, and some brokers, this all comes here. High liquidity and deep order books. So what's the benefit by using the centralized? Which means you will get a high liquidity. For example, we're already getting some ideas about this, right? Tata Motors, if you want to buy from 100 rupees, there must be a seller at 100 rupees. Okay, this is called the liquidity. If there is no seller at the 100 rupees, it's called the lack of liquidity. You're getting trapped, you're getting slippage. Your buy order is going to place at 101 rupees. You ordered at 100 rupees, but you got from 101 rupees. It's because there is no liquidity. Okay, liquidity means there's more engaged at a certain place, at a certain price range, so you can buy and sell easily at the same place. Okay, so in exchanges, centralized exchange, you can see high liquidity. Okay, so you'll get the buying and selling orders immediately without any delays. Okay, the heavy regulatory and oversight, I told you, right, they can change the rules. It depends on their rules. Okay, the next one is decentralized. Okay, there's like a low liquidity. Here low liquidity, here's high liquidity. In my concern, it's better to trade here. Okay, and keep your money here. Okay, no one is controlling. My concern is like you can trade here by opening a demat account here, and you can keep the money here in your wallet. So you are going to control this wallet. Okay, here in some cases they're going to freeze your accounts. Okay, this is a scenarios that's going to be happen. We're going to understand that later when we're creating a broker accounts. We are going to understand about this. Okay, the 8th or 9th class is about creating a broker accounts. Okay, so the next mistakes, people are making a big mistake here. They're ignoring about the markets. They thought that every market's movements is the same. For example, if you have some hedge, if you have some strategy which is works in stock market, that doesn't mean that it's going to work in Forex market, it's going to work in commodity market, it's going to work in crypto markets. So each and every markets moves differently. Their volatility, their spreads, and their liquidity, the time schedule, each and everything is different, right? So how can a single strategy is work in every markets? So that's a big mistake. See, I saw many people's, they're selling their courses that I have this strategy and I made this much of money by using this strategy, and it works in every market. You can make like a $10,000, $20,000 each and every week, each and every month. These are the scammers. Okay, they don't have any idea about these other markets. Each markets move differently. Each market's volatility difference. Each market's capital volume difference. Each market's liquidity. Each market's open and close time schedules is different. Right? We already learned about these all things. Which is a big market, the Forex market. Okay, the Forex market is a high volume markets. What is mean by high volume? See, I'm trading in Forex and I'm investing in stocks, equities, okay, for the long terms. That's my personal concern. That's my personal thing. But I don't prefer my concern, my personal things for everyone. See, I started with the stock market. I was trading the index at the beginning stage. Okay, I lose big money while trading index. Okay, because that's a futures and options. That's a speculative trading. Okay, if you understand the speculative, you can understand what I'm saying. Okay, then I shifted to the Forex market because it's a 7.5 trillion each and every day volumes. So no one can manipulate these markets. Okay, what is manipulations? We're going to understand in next class, in participant classes. Okay, the next big market is commodities. Commodity, which is gold, silver, crude oils. Okay, this all comes in commodities markets. It's around 3.5 trillion each and every day volumes. Okay, which means each and every day people are buying and selling worth of 3.5 trillion dollars. Okay, the next one is stock market. Okay, stock market, equities, index, this all comes in stock markets. The fourth one is crypto market. This is a low volume. So what mean by low volume and the high volume? If a market has low volume, it's going to be high volatile. Okay, so what is volatile? Volatile means like in short time, it's going to make up big movements, big move in a small short time frame. Okay, within 5 minutes we can see like 1,000 moments of movements in crypto markets. At the same time in forex, there were like a high moments in some pairs. That depends on the instruments, right? We already took an example by taking a sports example, right? If you're taking as a running, there's like a different kinds of instruments in that running, like 100 meter, 300 meter, 1,000 meters, marathon, relay, these are the things, right? So that's the same thing. If you choose any markets, there's a different kind of instruments here, right? In stock market we can see futures, option, index, okay, equities. These are the things this comes in forex. So sorry, in stock market there's the same thing is applied in each and every markets. Okay, so you always looks for the high volume markets. See, high volume markets means there's a low volatile. If you take the low volume markets, it's going to be high volatile. Okay, if you take the high volume markets, it's going to be low volatile. If there is any high volume, just imagine $7.5 trillion is market value or the volume in forex market each and every day, which means people can't able to manipulate this markets easily, right? So you will get some like a structured analysis. Your analysis, each and everything works here in forex market because it's like a high volume, low volatility markets. Okay, at the same time you can invest in equities also. Why equity? Because equity is driven by the company earnings and some technical analysis and fundamentals analysis. Okay, supply and demand, each and everything works in for everything. It's all frameworks, guys. But the difference is, don't look at each and every markets in the same way. Don't create a single strategy and don't think that that same strategies works in each and every markets. Okay, every markets moves difference, every market's behavior, each and everything is different. So in this summary we learn about this. If you're trading forex, you'll get enough liquidity. You can buy and sell at the same price that you're looking. Okay, the next one is equity. Equity for the long term, we already learned about. We are going to be a co-partner in that particular company. So if you're looking for the long-term career, long-term growth, equity is best for you because you need to find the best stocks, best company that works for the long term and you can invest there. If you want to become a scalper trader, within a short time you want to capture the big moves within 5 minutes, within 10 minutes, the crypto is best for you. It's a high volatile markets. And if you want to connect with me in social medias, Instagram, you can just search fynexfx. Okay, without any space, without any like anything, just fynexfx. And there's 2 YouTube channels. One is Fynex, and you will get here the full mentorship and my personal trades breakdown, each and everything I'm going to post here. Okay, the next one is Green Zone. So in this channel you'll get the full mentorship and continuous educational videos at Green Zone. This is our academy. Okay, that's it. Hope you guys get it. In the next class we are going to learn the market participants. The 1.3 module 1.3 about market participants who are investing in the market. Okay, if you want to buy in such places, there must be a seller. And who is that seller? If you want to sell your positions, there must be a buyer. And who are going to buy from you? In the next class we are going to understand who are the market participants and how much volume they're bringing to the markets and where your place in that market participants. You are the whale or you are just a dumb money in the markets. Okay, so stay tuned. After each and every classes, take your notes, and if you have any doubts, just search in like a ChatGPT and Gemini if you didn't get the answer from this video, or you can just comment it down. Okay, we're gonna clear that. That's it. Okay, hope you get it. I hope it's an informative video.